For decades, electric air taxis have felt like something straight out of a sci-fi movie. But we are right now, at this very moment, at a critical inflection point where that dream of flying cars is becoming a very real commercial reality. After more than a decade of hard work, design, and thousands of test flights, the core technology for what we call eVTOLs, that's electric vertical takeoff and landing aircraft, is finally coming of age. We're now seeing companies fly full-scale piloted prototypes, proving these incredible vehicles can actually operate safely in the real world. So, with the basic technology pretty much proven, the race to the skies isn't just an engineering challenge anymore. Oh no. It's now a battle of business models, manufacturing philosophies, and go-to-market strategies. In this explainer, we're going to deconstruct this whole race. We'll look at the 2025 inflection point, we'll analyze 5 totally distinct paths to market, we're going to confront the huge capital gap that every single one of these companies is facing, and finally, we'll separate the hype from the reality. Right now, the entire industry is in the middle of a massive shift. The era of just building one-off prototypes to prove a concept, that's ending. And the era of manufacturing certified production-ready aircraft, well, that's just beginning. So as you can see on this timeline, the early years were all about just proving the tech could work. But now, we're in this absolutely critical 2024 to 2025 window. This is where companies are doing piloted transition flights, and that's the whole ballgame. It's that crucial maneuver where the aircraft goes from lifting up like a helicopter to flying forward efficiently like a plane. The big target for many of them is to start flying passengers around 2026, with scaled-up manufacturing really kicking in by 2028. This period, right now, is where the leaders are going to pull away from the rest of the pack. And that brings us to the core of our analysis. See, while everyone's building an eVTOL, there is absolutely no agreement on the right way to build a business around it. So now we're going to dive into the 5 leading public companies and their radically different philosophies. First up, we've got Joby. The best way to understand their approach is to think of it as the Apple model of aviation, total control over the entire ecosystem, from the tiniest component all the way to the final customer experience. Joby's whole philosophy is that if you want to build a truly high-performance aircraft and lock in good margins for the long run, you have to do it all yourself. They design and build their own critical components, everything from the electric motors to the flight control software. They're also planning to own and operate their own air taxi service, managed by their own software. The goal here isn't just to sell planes, it's to own the entire value chain. Now, Archer is taking a very, very different path. Instead of trying to do everything in-house, they are tapping into the sheer scale and power of the automotive industry to solve that manufacturing puzzle. So while Archer keeps its core powertrain tech to itself, it's turning to the automotive giant Stellantis to crack the code on high-volume manufacturing. This is a huge move because it de-risks the enormous cost of building factories from scratch. Archer's also focused on building out its networks with airline partners and even has a dual-use strategy, developing versions for both commercial and defense use. Okay, let's move on to Beta Technologies. They see a much more practical and maybe even faster path to making money. Instead of starting with all the complexities of flying people around, they're starting with boxes. Beta's strategy is laser-focused on cargo and logistics first, a sector where there's already clear demand. But their model is so much bigger than just the aircraft. They're building a whole revenue ecosystem, including a nationwide network of charging stations and a really lucrative aftermarket for battery replacements. It's a very pragmatic, multi-layered approach to getting profitable fast. Now, Eve Holding is backed by the aerospace giant Embraer, and they aren't just trying to build an aircraft. They are trying to build the entire operating system for the whole urban air mobility market. Eve is leaning on Embraer's 55 years of experience certifying aircraft to de-risk their development. Their business has 3 pillars: selling the eVTO, providing maintenance and support, and offering a sophisticated air traffic software called Vector. But here's the key part. They plan to offer these services on an agnostic basis. That means they could become the support backbone for their competitors' aircraft too. And finally, we have Vertical Aerospace. They've gone with what you'd call an asset-light or partnership-heavy model. Basically, they focus on design and integration, and they let others handle manufacturing the components. Vertical's philosophy is to stick to what they do best, design and system integration, while partnering with established aerospace leaders for the parts. This approach spreads the immense financial risk across a big, robust supply chain. Their goal is simple: be a pure aircraft manufacturer, selling directly to customers like airlines and helicopter operators. So this table really sums up the huge strategic differences we've just talked about. You've got Joby all in on doing everything themselves, Archer is betting on automotive scale. Beta is taking the practical cargo-first route. Eve wants to be the service provider for the whole industry. And Vertical is the nimble, asset-light integrator. That's 5 companies making 5 profoundly different bets on what the future looks like. But here's the thing. No matter how brilliant the strategy, every single one of these companies faces the exact same monumental obstacle: money. The journey from a prototype to a certified, mass-produced aircraft is unbelievably expensive. And this brings us to a really crucial concept we call the capital gap. Put simply, it's the shortfall between the cash a company has in the bank today and the hundreds of millions or even billions it's going to need to get its aircraft certified and actually start mass production. This chart gives you a pretty stark visual of the problem. For pretty much every company in the space, that blue bar, representing the cash they have on hand, is just dwarfed by the red bar, showing what it's estimated to cost to get to the finish line. Closing this gap is going to be the single biggest factor in determining who survives. And look, this isn't just an analyst's opinion. This is a direct quote from Beta Technologies' own SEC filing, a legally required warning to their investors. It is a very stark, very public admission of the immense financial challenge that defines this entire industry right now. So let's just assume these companies can somehow navigate that capital gap. Even then, there are still major, real-world hurdles to overcome before we see electric air taxis buzzing around our cities. The promise, of course, is compelling. I mean, journeys up to 10 times faster than driving, with almost silent flight and 0 emissions. But the reality is a lot more complex. Success depends on way more than just the tech. It's going to require winning over the public, managing noise in cities, building out a whole new network of vertiports, and navigating an incredibly complex regulatory landscape. And this is the crucial point. We are seeing these aircraft in the sky. The technology itself is no longer the primary question. The engineering is working. The whole industry is now just holding its breath to see which business model will actually get off the ground. So ultimately, this brings us to our final thought. The race has changed. It's really no longer a question of if this technology will arrive, it's a question of how it will arrive. Will it be a completely self-contained service, an open ecosystem, or something else entirely? The next 5 years are going to decide whose vision of our future skies becomes our reality.